Rome was not built in a day, but Hiroshima and Nagasaki were destroyed in a day. Probably you heard this before. Mr. Vijay Kedia of Kedia Securities have put this analogy into an investment context. In relation to investment practices, this highlights the importance of long-term planning, disciplined saving, and the understanding that wealth accumulation and financial success does not happen overnight. However, unexpected events can wipe out years of gains, such as market crashes, economic shocks, or crises. It's a reminder that despite the slow, steady effort of building wealth, external shocks or volatility can cause swift and severe setbacks. So, pertinent question here should be how to overcome or mitigate those investment risks. We know no asset class is completely risk-free. However, we can mitigate those risks to a good extent by following proper asset allocation, diversification, and so on. And most importantly, in my view, by doing long-term planning, how to manage your finance and investments. Hi, I'm your host. Welcome to NetInvestible. As promised, today I'm going to take you through the major steps involved in personal finance. In this personal finance series, I will share with you 5 videos covering each life phases. In today's video, I will give you the high-level overview of various stages of life in relation to financial planning. But before I start with the phases, I want to talk about the importance of money. And I want to start with my favorite quote that goes like, money is not everything, but for everything, money is required. I have seen people saying money is not important, money is not required. Rich people are thin, greedy, and so on. In my view, they very well know money is important. What they're trying to say is that I don't want to pay the cost to acquire enough money. I don't want to do the hard work, right? Secondly, human psyche is such, it doesn't go hand in hand with what it takes to create wealth in long term. We are so fond of instant gratification. I need this right now. I can't wait for a year. I can't wait for 5 years. Things like that, which is opposite to the universal law of having patience to achieve anything significant. Even when we are into the process and we are following the right approaches, we still commit many mistakes. Not investing enough in improving our skills that may improve earning potential. I think unless you have enough money, your investment will take a lot of time to turn the initial capital or regular investment into a significant corpus. According to a data set published by Association of Mutual Funds in India, India is in top 5 major countries in terms of net household saving percentage. We are at 30% right now. We are just below Singapore, China, and Indonesia, and way ahead of US, UK, Germany, and Japan. But at the other side, the fact is discouraging. India is in the bottom countries when compared with major economies in relation to mutual fund AUM to GDP ratio. So, in simple language, this ratio talks about what is the total asset under management into the mutual fund category in the country in relation to the overall GDP numbers. So our ratio for India is just 18% and US is at 130%. That means mutual fund AUM in US is 1.3 times of its total GDP. Another major point to add here, we still rely on gold, real estate, and deposits, but we know the yield of these asset classes. In terms of the requirement of insurance also, as a country, we are grossly under-insured, be it health, or life. Adapting to the changes in the business environment and technology. So, you see, the techniques that worked 30 years ago may not be appropriate right now. Alright, let's begin with the life cycle phases. Phases are generally divided in 4 parts. In the accumulation phase, individuals should focus on maximum savings and investment, raising the income, increasing the income, investing on your skills so that you can improve your income skills, overall income, and invest those money into the right financial product, building a big corpus that can remain invested for a long period of time. 3 major components of accumulation, in my view, would be regular contribution, high savings rate, and high growth investments. During this phase, one should focus on investing and spend judiciously. By the way, we will discuss in detail the accumulation phase in our next video. During the growth phase, investment grow in value, and investors tend to take on more risk for higher return. So they switch more into the equity related product, the risky product, where the growth is also proportionate to the risk you undertake. The focus is on expanding your wealth and increasing assets, often with a longer term horizon. And in the prevention phase, this is when the focus shifts from the aggressive growth to protecting accumulated wealth. Investors prioritize stability, income, and avoiding significant losses in this phase. Investment strategies may include more conservative assets like fixed income securities, things like product like bonds, deposits, etc. And in the final phase, which is retirement and wealth transfer phase, the goal is to generate a steady income to fund living expenses, adjusting strategies to minimize the risk, because the risk-taking capacity diminishes in this final stage, and transferring wealth to heirs or charities, managing various estate-related plannings, taxes, etc. Generally, these phases overlap with each other, require absolute clarity through planning and execution. So to summarize, I want you to be mindful of these points. Number one, focus on increasing your income so that you can increase your investment. Number two, start or continue to invest, not just saving, continue to invest regularly. 3, increase your investable allocation toward financial assets as opposed to the real assets like real estate, golds, and things like that. Ensure adequate insurance cover, because a health emergency or a life emergency may impact and may diminish your overall financial capacity and health. Plan for your retirement today. Don't wait for another 10 years to come and then start planning for your retirement. That never works. And last point, invest in legitimate investment product. Yeah. So with that, I would end this video. Do subscribe and hit on the bell icon for notification to my next video, which would be more detail on the accumulation phase, what we are supposed to do and how we should achieve maximum accumulation of wealth and assets. Till then, take care. Have a good day.